Assalamu alaikum wa rahmatullahi wa barakatuh. If Islamic banks do not use interest, how do they actually benefit? And why is this model not only viable but thriving? To understand this, it's important to look at the core differences between conventional, interest-based banking and the Islamic financial model. Conventional riba-based banks operate on a system of lending and borrowing with interest. When a customer deposits money in a conventional bank, that deposit is essentially a loan from the customer to the bank, which the bank is obligated to pay back with interest. Meanwhile, the bank takes this pooled deposit and lends it out to other customers, again with interest, profiting from the difference in rates. All of this profit comes from riba, an increase in capital without any genuine productive activity. This setup leads to a system centered around money simply generating more money, detached from tangible economic ventures. Islamic banking, on the other hand, revolves around transactions that are Islamically permissible, such as buying, selling, profit sharing, mudaraba, and partnerships, musharaka. Instead of paying you a fixed, predetermined rate, an Islamic bank invests your money into real business projects, like a construction development, a manufacturing operation, or a trade venture. The returns you receive are tied directly to the success of these projects. If the venture is profitable, both you and the bank share in those profits proportionately. If it does not perform well, both parties share in the losses. This framework encourages honesty, due diligence, and risk management, since the bank must carefully select and monitor its investments. By avoiding riba, Islamic banks ground their operations in tangible assets and actual economic activity. Profits are earned through real-world commerce, rather than the mere passage of time. There is often greater potential for profit than the fixed interest rates found in conventional banking. Although this comes with the natural risk of entrepreneurship, still, this risk is considered healthier for the overall economy, because it discourages reckless lending and ensures that financial success is tied to creating real value. In addition to profit-sharing investments, Islamic banks can charge fees for legitimate services such as facilitating currency exchange, processing wire transfers, and providing advisory support. These fees are not interest, they are compensation for actual services rendered. By maintaining transparency and adhering to Islamic principles, these banks foster trust, which can attract customers who value both ethical considerations and economic growth. Riba-based transactions that Islamic law prohibits are numerous, including lending money with interest, delaying currency exchanges without the immediate hand-to-hand transfer, and trading gold or similar commodities in unequal amounts or at different times. All these practices turn money into a commodity that breeds more money without contributing to real economic development, which goes against Islamic financial ethics. Today, Islamic banks are flourishing in many parts of the world. They have proven that avoiding riba does not mean avoiding profitability. Some non-Muslim majority countries have even incorporated aspects of Islamic finance into their systems, recognizing its potential to promote stability, fairness, and sustainable growth. In essence, Islamic banking benefits by actively participating in economic ventures, encouraging shared risk and reward, promoting responsibility, and avoiding the pitfalls of interest-based financial cycles. It aligns finance with ethical principles, leading to a system that is not only permissible from an Islamic standpoint, but also appealing to many who seek a fairer and more stable financial environment. Jazakum Allahu khairan for watching, and Assalamu alaikum wa rahmatullahi wa barakatuh.